In this video, we discussed the allocation of joint product costs. After watching this video, you should be able to explain why the allocation of joint product costs is important and how to allocate joint product costs using a net realizable value method and a physical quantities method. In some industries, a number of end products are produced from a single raw material input. Two or more products produced from a common input or process are referred to as joint products. The point in the manufacturing process where each joint product can be recognized as a separate product is referred to as the split-off point. We're concerned with allocating the costs incurred prior to this split-off point. For example, in the oil and gas industry, there's a common production process that incurs joint product costs. These costs would be the cost of exploration, the cost of drilling, the cost of obtaining land rights. And out of this joint production process, two products emerge, both oil and natural gas. Where these two products come out of the ground is referred to as the split-off point, and all of the costs incurred prior to that split-off point are common costs and joint product costs that need to be allocated to these products. And we can consider allocating these costs based on physical quantity measures or the net realizable value or relative market value of these two products when they're extracted from the ground. A third method we're going to consider is the fact that both of these products can be refined further. A large number of products are extracted from crude oil and natural gas. They include gasoline, jet fuel, home heating oil, lubricants, asphalt, and various organic chemicals. So we can sell natural gas or oil at the point of extraction or incur additional processing costs and sell these as refined products. The separate processing costs are traceable and can be allocated to the individual final products that we sell: the gasoline, the jet fuel, the home heating oil, chemicals. But of course, we're still left with the challenge of allocating the common production cost, or those joint product costs. Allocating these costs is important because we typically use cost or profitability to evaluate performance. Knowing costs is important for determining inventory values for both the balance sheet as well as cost of goods sold on the income statement. And again, in this video, we'll consider two different methods: the net realizable value method and a physical quantities method. We will consider these in the context of the Carlisle Coal Company. Here is a cost flow diagram for the Carlisle Coal Company's Hilltop Mine. The costs include materials, labor, manufacturing overhead. As the coal is mined, two products, high-grade coal and low-grade coal, emerge from the process. We extract 15,000 units or perhaps tons of high-grade coal with a sales value at that split-off point of $300,000. At the same time, we extract 30,000 units or tons of low-grade coal with a sales value of $450,000. We will begin by considering the allocation of joint product costs using a physical quantities method, where the joint cost allocation is based on a measurement of volume, weight, or other physical measure of the joint products at the split-off point. Here's the information given for our problem. We're told that we have 15,000 units or tons of high-grade coal, 30,000 of low-grade coal, and the relative sales values at the split-off points. Let's go ahead and do this using our physical units. We begin by picking up the number of tons for high-grade coal. 15,000 was given, 30,000 for low-grade, for a total of 45,000 tons. 15,000 of the 45,000, or 33% of the tons of coal we produce, is high-grade, and the other 2/3, or 66.7%, is low-grade. So we will allocate $90,000 of our joint product costs, which we're told is $270,000, to the high-grade coal. That's 1/3 of the cost. The other 2/3 of the cost will be allocated to the low-grade coal. Make sure that your totals foot that the amount of cost you've allocated equals the $270,000 in joint product costs. We're now going to look at the cost allocation using the relative sales value at split off. Be careful, your textbook refers to this as the net realizable value at split off. This is more frequently referred to simply as the relative sales value or market value at split off. The term net realizable value at split off usually refers to our net proceeds if we process it further. That is what we are left with after we incur additional processing costs, hence the term net realizable value. Net realizable value is the final selling price minus any additional processing costs, which are attributed directly to the individual products. Again, net usually means gross minus something. We're given the sales value at split off point and the total for the two products. Let's pick those up. First, the high grade coal, $300,000, the low grade coal for $450,000, total sales value at extraction of $750,000. The low or the high grade coal accounts for 40% of the value at split off. That's the $300,000 divided by $750,000. The low grade coal is the remaining 60%, the $450,000 divided by $750,000. Make sure you've accounted for the full 100% of the cost, and then we simply allocate the cost. 40% of the $270,000 or $108,000 will be allocated to high grade, and the balance of $162,000 will be allocated to the low grade. Again, make sure you've accounted for the full cost. Again, your textbook refers to this as the net realizable value at the split-off point. It's usually referred to as the relative market value at the split-off point. The net realizable value typically refers to the value if we process the intermediate products further, and it's the final selling price minus any additional cost necessary to prepare our product for sale. Let's go ahead and look at that final method, the net realizable value with further processing. First, we need to calculate the net realizable value after further processing. For the high-grade coal, we don't process it any further, and so the net realizable value is $300,000. The low-grade coal, though, we process it further to remove impurities such as sulfur or other types of unwanted pollutants, giving us a final sales value of $800,000 if we process it further. Let's go ahead now and pick up the net realizable value after further processing. For the high-grade coal, it's still the $300,000. The low-grade coal is $500,000 for a total of $800,000. In terms of a percentage of our final sales value, the high-grade coal will be 37.5% of the value, the low-grade 62.5%. For the high-grade, we assign 37.5% of the $270,000 to the high-grade coal, and we allocate $168,750 in cost to the low-grade coal.